Speaking of stocks that you don't want to see sprain an ankle, and maybe one did this week, Will Stein, and maybe that's Tesla. So how do we view this after earnings, the pullback we saw, stocks bouncing here by a 1.25% or so? You did downgrade it today. Why?
Yeah, there's a change in outlook relative to the company's pricing strategy. The company's taking an approach whereby they want to run the fabs, or rather the factories, at approximately full utilization, and they're going to price however they need to in order to ensure they can continue to clear all that inventory. That suggests downward pressure for both revenue and margins. That takes my valuation down, and hence the required downgrade.
Even with their margins, obviously so much higher than the others in the space that they compete with, you're worried about, more drop in margins and more price cuts too?
Yes, it's an incredible advantage for this company. They have this operating margin padding that they can use as a weapon, if you will, relative to other companies. Now, I don't think they're using this as a way to damage other traditional automotive companies or even some of the other emerging electric vehicle companies. They're doing it simply to run their strategy, which is to continue to run the factories at nearly full utilization as they're continuing to add significant more capacity. They have the Cybertruck coming later this year. They have supposedly the next gen, or the so-called robotaxi, coming at the end of next year. And that this is the strategy. They're going to lower price in order to do that.
What about momentum? The stock had a ton of momentum going into the report. Does the release slam the door on that?
We think that the negative news, and this was more or less told to us by Elon Musk on the earnings call, that the outlook for the next few months, approximately a year, is that we're headed for some tough times relative to demand, and the only way that this company is going to allow demand to come in enough to allow them to continue to sell the inventory that they're manufacturing is to lower prices. There were no mixed words about this. We're headed for some cloudy times for the next few months, or likely a few quarters for this company.
AI is a part of this too, the way you're thinking about what the overall impact is as revenue goes towards AI at the expense of the core business, right?
Well, that's not exactly the way we look at it. We tend to look at this as an AI asset primarily. There's no getting away from the fact that this is an automobile manufacturer, but it's one of the main points we highlighted in our launch report, that we really view this as an AI technology company. That's an underappreciated aspect of the business. We don't see a shift. We see a change in the valuation of the core automotive business. Musk talked about this yesterday in the earnings call, that one could look at this as sort of a razor and razor blade model. We'll sell the razors, i.e. the cars, at a, potentially down to break-even cash flow level in order to seed the market, increase adoption, and enable us to sell autonomous technology and other AI technology to our customers. Great for margins longer term, great for cash flows, great for that focus on AI and new and interesting things for this company.
Yeah.
But it's a problem for the core automotive business.
Well, I appreciate it very much.